Somewhere in Washington this afternoon, a committee that spent 13 days last month debating a number it refused to write down will finally let the public read what it actually said. Silver is sitting just under $60 an ounce this morning, gold just above $4,100, and both are lower than they were on Monday for reasons that have nothing to do with silver or gold at all. Overnight, American aircraft struck more than 80 targets inside Iran. Washington revoked the waiver that had allowed Tehran to sell crude on the open market. Oil jumped 3% before most of this country had finished its coffee. The dollar firmed on the reflex flight to safety that a nervous world still performs on cue, and two metals that had just posted their best week in more than a month gave a portion of it back before lunch. None of that is the story. The story is what happens at 2 o'clock this afternoon, when the Federal Reserve releases the minutes of a meeting so strange that Wall Street is still arguing about what actually happened inside the room. By the end of this, you will understand exactly why a document nobody outside Washington will ever read in full is capable of moving your silver holdings more than a war can. And you will understand why the number in this video's title, 55 or 70, is not clickbait, but arithmetic. Start with what is verifiably true this morning, because in a market, this jumpy precision is a form of honesty. Silver has pulled back from last week's rally, trading in the high $50 range, down from an intraday touch near 63 earlier this week. Gold has slipped toward $4,100 an ounce, off its own 2-week high. Neither retreat reflects a change in the underlying case for either metal. What moved them was Iran, and before Iran, it was simply positioning ahead of an afternoon that traders have circled on their calendars for 3 weeks. Zoom out to last week, though, and the picture looks entirely different. Silver posted its strongest weekly performance in more than 5 weeks, and gold notched its first weekly gain since late May. That entire move traces to a single Thursday release, and understanding it properly is the price of admission for everything that follows. The Bureau of Labor Statistics reported that the American economy added just 57,000 jobs in June, against forecasts calling for something closer to 110,000. That is not a soft miss. That is a number cut in half, the weakest print in 4 months, delivered alongside downward revisions to the 2 prior months that made the underlying trend look even softer than the headline. Here is the mechanism, because understanding it is what separates watching this market from merely reacting to it. Silver pays no dividend. It offers no yield. It sits in a vault or a drawer and does nothing but exist, which means its entire appeal relative to a bond or a savings account depends on how much you're giving up by holding it instead. Weak jobs data lowers the odds of a Federal Reserve rate hike, which lowers that opportunity cost, which sends capital drifting back into precious metals with the reliable indifference of water finding a lower elevation. Within hours of that report, the market's own probability tool for the Fed's next move slid meaningfully lower, and the dollar logged its worst week since April. A softer dollar makes silver cheaper for every buyer transacting in yen, euros, or rupees, which is a second tailwind stacked directly atop the first, not a separate story running in parallel. Silver broke $60 almost immediately and briefly touched 63 within the following 2 sessions. Curiously, the unemployment rate actually ticked down to 4.2%, even as the jobs number collapsed, an inconsistency that has divided opinion inside the Fed itself. Some officials reading a falling unemployment rate as proof the labor market remains sound, others reading 57,000 jobs as evidence of a cooling that the unemployment figure alone conceals. That argument, unresolved, is precisely what today's minutes exist to settle, or at least to illuminate. Now to the man at the center of it. Kevin Warsh took the chairmanship in May, the culmination of months of public pressure from President Trump against his predecessor, Jerome Powell, who, in an unusual gesture, chose to remain on the Fed's board of governors even after ceding the chairmanship, a quiet signal that the transition was not entirely smooth. Every serious observer of this market, this narrator included, went into Warsh's first meeting on June 17th expecting rate cuts, because that is what Warsh had been associated with earlier in his career and what markets were broadly positioned for. What happened instead was closer to a small institutional earthquake. Warsh held rates steady at 3.5% to 3.75%, unsurprising in itself. What surprised people was everything wrapped around that decision. The post-meeting statement, ordinarily several paragraphs, ran to roughly 130 words. The quarterly projections, the famous dot plot that has served as Wall Street's roadmap for a decade, shifted from a single anticipated cut in March's projections to 9 of 18 participants, signaling support for a hike by year's end, 6 of those 9 favoring 2 separate increases. And Warsh himself submitted no dot at all, declining to project his own rate path in a tool he has since said he does not find especially useful. He also announced 5 separate task forces to review how the Fed communicates, sources its data, evaluates inflation, and manages its balance sheet, an undertaking that amounts to rewriting the institution's internal playbook. Days later, at the European Central Bank's forum in Sintra, Portugal, he was asked directly where policy goes from here, and he declined again, saying only that judgment on the tactics and the strategy is still to come. A chairman who has deliberately withheld the market's usual compass, sitting atop a committee half of which is already leaning hawkish, while a single soft jobs report simultaneously pulls short-term expectations the other way, is not a situation that resolves itself quietly. It is exactly the kind of tension that gets photographed in black and white the moment a transcript becomes public. And that transcript prints in a few hours. If any of this has made the next 72 hours feel clearer instead of louder, do one thing for this channel before we go further. Subscribe now, because the moment those minutes cross the wire this afternoon, this channel will be reading them line by line the same day, not a day late and not a week late. And you will want to already be here when that happens. There's a second market operating entirely apart from Washington's theater, and it deserves as much attention as anything Kevin Warsh says today, because unlike a Fed statement, it cannot be rewritten or withheld. It lives in the COMEX vaults themselves. Registered silver, meaning metal that has been formally warranted and can settle a delivery notice today with no further steps, has fallen dramatically over recent years, down by roughly 3/4 since 2020, from north of 340 million ounces to somewhere near 88 million as of the most recent published figures. Eligible silver, sitting in the identical vault, meeting the identical purity standard, but lacking that formal warrant, makes up the larger remaining balance of COMEX's total stock. When registered inventory climbs while total stock barely moves, owners are actively converting eligible metal into deliverable form, a signal that someone anticipates needing it. When registered stock drops sharply in a single session, as it has done before, that is real delivery demand pulling metal physically out of the system, not a rounding error on a spreadsheet. Layer open interest on top of that vault data, and the tension becomes visible. Open interest measures the total outstanding paper promises to buy or sell silver at a future date, translated out from futures contracts of 5,000 ounces apiece into an ounce equivalent figure that has recently sat well above 200 million ounces on the front months. Compare that against a registered stock hovering near 88 million ounces, and the resulting coverage ratio, the paper claims, stacked atop every certified deliverable ounce, sits in a range that would have alarmed a 19th century bullion broker. I want to be careful here, because this figure gets sensationalized constantly across this corner of the internet, and I have no interest in doing that to you. The overwhelming majority of those paper contracts roll forward or settle in cash. They were never going to stand for physical delivery, and a thin coverage ratio by itself is not proof of an imminent squeeze. It is not a crisis signal. It is a sensitivity signal, a market with a thinner cushion than it has had in decades. And a thin cushion, this year of all years, is not a comforting place to stand. The piece of this story that most Western coverage misses entirely is happening on the other side of the planet while New York sleeps. Chinese physical silver premiums on the Shanghai exchanges have persisted meaningfully above London and New York spot pricing. Through much of this year, a gap that should, in a perfectly efficient world, arbitrage itself flat almost instantly. It has not, for two structural reasons. Capital controls and logistics make moving physical metal between Chinese and Western markets slower and costlier than a textbook would suggest, and Chinese industrial demand for silver has simply not slowed, whatever the Federal Reserve does with its dot plot. China manufactures roughly 4/5 of the world's solar panels, and every panel requires a silver conductive paste for which there is currently no viable substitute at industrial scale. A layer on electric vehicles, fifth-generation telecom infrastructure, and semiconductor fabrication, and you have a buyer that needs the physical metal irrespective of what Kevin Warsh says in Washington. A market that keeps paying a premium instead of discounting alongside a Western pullback is telling you something about which side of this trade believes in the structural story, and which side is simply reacting to this week's headlines. Zoom out further still, because a single dramatic week, however loud, does not erase years of accumulated arithmetic. The Silver Institute's own World Silver Survey, published this spring alongside the consultancy Metals Focus, put the 2026 global deficit at 46 million ounces, the sixth consecutive year that demand has outrun supply, widening from just over 40 million ounces the year before. Global mine production remains essentially flat near the mid-800 million ounce range, a stubbornness with a specific cause. Roughly 3/4 of all mined silver arrives as a byproduct of copper, gold, lead, and zinc extraction. Which means, even at today's elevated prices, most producers cannot simply flip a switch and chase silver because they are mining something else, and silver is the bonus that comes along for the ride. Since 2021, the market has drawn down more than 760 million ounces from above-ground stockpiles to close that gap. The exchange vaults, the exchange-traded fund holdings, the private stockpiles built up across decades, none of which refill themselves. Every year that deficit persists, the cushion protecting this market from a genuine shock gets thinner, whether or not Kevin Warsh cuts rates next month, and whether or not the missiles over the Strait of Hormuz keep flying. So, 55 or 70. Let us build both cases honestly, because feeding you only the flattering half would insult the 6 years of work this market has already done for its own defense. The bearish case rests on real technical support near $55, roughly where prices sat in the autumn of last year, reinforced by longer moving averages that have not yet caught up with recent volatility. If today's minutes read more hawkish than the sanitized June statement suggested, if more committee members were pushing for an immediate hike than the public record implied, rate expectations snap back quickly, the dollar strengthens on that repricing, and silver's opportunity cost problem returns to the foreground overnight. Thursday's jobless claims figure could reinforce that reversal or undercut it entirely. A single surprise in either direction can unwind in 3 days what took 10 to build. Against that, the bullish case rests on numbers that do not require today's minutes to cooperate at all. A Reuters poll of analysts has put the 2026 average silver price near $80. JP Morgan's own published call sits close to that same figure. Bank of America's metals research has floated a considerably wider band built on the gold to silver ratio, compressing toward the extremes last seen in 2011 and further back in 1980, though even that bank frames its upper bound as a stress scenario rather than a base case. None of those targets depend on Kevin Warsh's mood this afternoon. They depend on the deficit math, the deliverable supply squeeze, and a Shanghai premium that has shown no interest in closing. Here's the honest synthesis, offered without the false comfort of certainty that so much of this space traffics in. A hawkish read on this afternoon's minutes, paired with a hot claims number Thursday, points toward a retest of the lower band, potentially all the way to 55, if the reversal carries real conviction and the Iran situation keeps the dollar firm. A dovish red, paired with continued softness in the labor data and some cooling in the Middle East, extends the bounce already visible off last week's jobs miss and puts a retest of 63, then perhaps 70, back within reach before the month is out. What does not change, regardless of which way this afternoon breaks, is the coverage ratio thinning in the COMEX vaults and the premium holding firm in Shanghai. Those are not calibrated to the Federal Reserve's meeting schedule. They are the 6-year current running beneath whatever headline crosses the wire at 2 o'clock, and a market can be moved by a headline for an afternoon, but it is eventually governed by its arithmetic. That is the full picture heading into this afternoon. The jobs report that started the move, a Fed chairman who tore up his own communications playbook and then declined to hand you a new one, vault numbers most channels either skip or garble, and a 6-year structural deficit that keeps running whether or not anyone in Washington is paying attention to it today. If this made a genuinely confusing week easier to hold in your head, say so in the comments, and tell this channel honestly where you think this lands, 55 or 70, and just as importantly, what you're actually holding into the print this afternoon. ETF shares, physical bars, mining equities, or plain cash on the sidelines, watching from a safe distance. Every comment gets read. And remember, this is for education and discussion only, not personal financial advice. I'm sharing a way to think through the history, the market, and the ownership questions so you can make your own decisions with your own money and your own risk in